Welcome to episode 3 in our ongoing series about crypto market valuation. This series is really reflective of a strategy that I'm going to be using to help me time market entry and exit and get a sense of when the market top for the cryptocurrency market as a whole is likely to occur for this market cycle. In this episode, we will be talking a little bit about Bitcoin indicators that I'm using. However, if you've not watched episode 1 and 2, I would urge you to go back and look at them, as they really contextualize some of the discussion we're going to have today. Now, in episode 1, if I can summarize it very quickly, we described the fundamental premise that I'm using for understanding what is likely to happen in this market cycle. And that's really this notion around Bitcoin being the market dominator. So if we understand where Bitcoin goes, we'll have a good understanding where the altcoins are likely to follow. In episode 1, we also looked at different scenarios for Bitcoin, and we ended up settling on the most likely scenario being that Bitcoin will play out into this gold 2.0 narrative. Okay. Then in episode 2, we looked at how this gold 2.0 narrative might play out in terms of forward price projection. Okay. And in that space, we looked at two theories, model theories. The first theory is called lengthening cycles, diminishing returns. And the second price theory is what is called stock to flow. At the end of that episode, we asked which of the two is the correct one. And as far as I'm concerned, it's a little too early to tell. I suppose we could say that for sure neither of them are correct, because as we know, all models are wrong, but they can sometimes be useful. So I guess then the question is which of the two is the more useful, right? And at this point in time, I just think it's too early to tell. So we'll continue to monitor both models, and I will touch on these models in this episode and explain how I'm looking at them and how I'm using them. Okay, so before I go any further, I again have to do the standard disclaimer. None of what I'm describing here today is investment advice. Investing in cryptocurrency is not risk-free. So any use of this information is purely at the user's own risk. I'll also add that in this presentation, as we talk about indicators, some of you who are familiar with technical analysis might be expecting to see some TA, technical analysis. It's not my preferred methodology in my approach. Now, that's not to say that I don't think TA is valuable. I've just not elected to use it. I think for my purposes, the indicators, as I'll describe in this discussion we're going to have today, suits my needs. Okay, perhaps over time it could be enhanced with TA, but for now, I think this is more than adequate. I think it's also probably worth mentioning that if you do like this content, we would appreciate a like. And as I said, this is an ongoing series. We're likely to issue 5 episodes. So if you hit that subscribe button, you will get prompt notification, hot off the press, as they say, when the new episodes get released. Okay, so how are we going to go about today's presentation? Well, we'll start off by talking a little bit about how Bitcoin is spent. Now, again, as with the previous episode, I appreciate that this is probably, for some of you who are not new to Bitcoin, this is old news. So the episode will be timestamped. Please feel free to skip ahead. But for those of you who are new to Bitcoin, it's important that you understand some of these basic concepts because they feed into how we use the indicators. So as I said, we'll talk a little bit about how Bitcoin is spent, and then talk about the first indicator called the net unrealized profit and loss indicator. Then I will talk a little bit about how Bitcoin is mined. And again, this is timestamped, so feel free to skip ahead if you're familiar with this. But it's important that we understand this mining process because some of the terminology that we use is important for the next indicator, which is the Bitcoin Thermocap ratio indicator. And then we will close the discussion with the third indicator, which is what I call the stock to flow and lengthening cycles diminishing returns progression indicator. These will refer to some of what we talked about in the last episode. Just another thing to add, I'm not going to go into too much technicalities around how Bitcoin is spent or how Bitcoin is mined. It's really just going to be an overview, which will be sufficient for the purposes of this episode. Again, I would encourage people new to Bitcoin to seek out other online resources. There's really a lot out there to get a deeper understanding of these concepts, because it's really fascinating, firstly, but also important. If you're an investor into something, it's important to understand how it works. Okay, so let's get stuck in. This is from an investment company called Ark Invest, from one of their position papers that they released in January 2021. And this is what they had to say. In the same way that a government statistical agency publishes data about a country's population and economy, or a public company publishes quarterly financial statements disclosing growth rates and earnings, Bitcoin provides a real-time global ledger that publishes data about the network's activity and inner economics. In the absence of central control, Bitcoin's blockchain provides open source data, its integrity a function of the network's transparency. Now, why did I read this quote out? Well, I want to highlight one of the unique features about Bitcoin that separates it from pretty much every other asset class out there. And that is because the information is all available on a transparent global ledger that is not centrally controlled, it's decentralized, so we all have access to it. We obtain an incredible amount of information in real time around what the protocol is doing, how Bitcoins are being spent, how Bitcoins are being created, where Bitcoins are moving to. This is incredibly insightful, okay? So what that allows us to do is develop indicators based on on-chain real-time information. These types of indicators are called on-chain indicators, okay? And that's what we'll be looking at today. Okay, but let's understand a little bit, before we sort of dive into the indicators, let's understand a little bit about how Bitcoin is actually spent. Okay, so the first thing, if you're new to Bitcoin, the first thing you need to get your head around is that you don't physically take possession of any Bitcoin on any device that you own, right? Your Bitcoin wallet, which would be one of the first things that you will get before you before you access your Bitcoin or before you buy any Bitcoin. Your Bitcoin wallet is really you could think of it as a key that gives you access to your coins that are on the blockchain, right, or that are housed in the protocol. So all the coins that have ever been minted, and it's around 18 to 19 million, somewhere between 18 and 19 million at this point in time of the 21, they are all sitting on this decentralized ledger, and your wallet gives you access to your coins that sit on that ledger, okay? The coins themselves are known as unspent transaction outputs, UTXOs, okay? So the way to think of a UTXO would be like a check. If you wrote out a check you can write out the check for, any kind of denomination, right? It's not like currency where it comes in fixed coins or notes, right? That have fixed values. A check you can write out for whatever value that you would like to use. Okay, so I'm going to use a little example where Alice, who has 0.03 Bitcoin, her wallet gives her access to her Bitcoin that's on the blockchain at the moment. So that exists as an unspent transaction output, a UTXO, along with everybody else in the world. Okay, so Alice would like to send 0.01 Bitcoin to Bob. Okay, so what Alice would do is she will, in a wallet, get Bob's address details, uh, enter it into her wallet, and send 0.01 Bitcoin to Bob. Now, what happens is that 0.03 Bitcoin that Alice originally had, that gets, I guess, locked up on the blockchain. So it's frozen. It never gets used again. It just acts as a record. And what Alice gets is 0.02 Bitcoin back, and Bob gets 0.01 Bitcoin. Okay, so then the new block on the blockchain will reflect that Bob now, with his associated wallet, has access to 0.01 Bitcoin, which he can do with what he wishes, and Alice has 0.02 Bitcoin. Okay, so she gets left with her UTXO of 0.02 and Bob with his UTXO of 0.01. And that has been now timestamped on a block on the blockchain. Okay, and if there was a transaction after that, it would follow a similar process. Okay, so now that we understand how UTXOs work, we can look at our first indicator, the net unrealized profit and loss indicator, or the NUPL indicator for short. Okay, and the NUPL indicator, it's not overly complicated to calculate. Okay, essentially what you do is you take a UTXO and you look at the value of that UTXO when it was created by multiplying the UTXO quantity by the price of Bitcoin at that time. Okay, and then we look at the UTXO at some time in the future again, and if the price has increased, the UTXO then is said to be in a state of unrealized profit. Okay, in other words, if we were to then sell that or spend that UTXO, we will make a profit because the price when the UTXO was created versus the price today, there was an increase. Similarly, if the price is lower than the price at the point in time when the UTXO was created, then the UTXO is said to be in a state of unrealized loss. Okay, the loss or profit becomes realized when you spend the UTXO, because that's essentially when you take profit or when you take loss. Okay, so we can then aggregate this across the entire blockchain. Okay, so we can get a sense of whether the blockchain as a whole for Bitcoin is in a state of unrealized profit or loss. Okay, now let's look at the indicator on a chart and see if it shows us anything interesting. So what you can see there is when the UTXO is above, sorry, when the NUPL indicator is above 75%, okay, corresponding to those little blue peaks over there, those seem to correspond very well with market tops, okay, highlighted by the circles on the graph. If we look at the market top in 2017, the NUPL indicator, which was above 75% then, indicated 10 days before the dump, okay, before the market top, and then the whole market went into decline after that. Okay, so a good metric then for us to look out for is when the NUPL indicator is above 75%. Now, it's not foolproof. If we look at 2013 and 2014, there was an indication of a market top in 2013, and certainly after the NUPL indicator flashed 75%, there was a decline after that. But the market rebounded and actually went up even higher. Okay, so it's definitely not foolproof, but it does indicate when we are hitting a peak. Now that peak might be a local peak or a market cycle peak. Similarly, when the network as a whole is in a state of unrealized loss, when the NUPL indicator is less than zero, those also correspond to market cycle bottoms, as you can see in the chart again, where the price sort of reaches a local bottom or market cycle bottom when the NUPL indicator flashes red. Okay, so the NUPL indicators can be used to give us an indication of a good time to buy as well as a good time to sell. Something else to say about all on-chain indicators, really. Now, that graph that you see there is from a website called Glassnode, and they sell you this information, right? And it's convenient if you're prepared to pay for it. But with a little bit of time in Excel, you can actually generate these indicators yourself. There are a few resources online. One of them being coinmetrics.com, which gives you raw blockchain data free of charge. So with a little bit of manipulation of that data in Excel, you can create the NUPL indicator yourself, which is exactly what I've done. Okay, so now that we understand the NUPL indicator, let's move on to the next indicator, the Thermocap. But before we do that, we have to understand a little bit more about how Bitcoin is mined. So again, using Alice and Bob, in our previous example, Alice wants to buy something from Bob for 0.01 Bitcoin. So what Alice would do is she would open up a wallet, get Bob's wallet address from Bob, and then in her wallet, plug in Bob's address details, assign 0.01 Bitcoin to it, and then click send. Now, when she clicks send, what then happens is that transaction goes into the waiting pool of other transactions waiting to be written to the blockchain. This is called what is called the mempool. Okay, when her transaction gets prioritized for being written to the blockchain along with a group of other transactions that were waiting in the mempool, they then form a preliminary block, which miners on the blockchain then compete for the right to write those blocks of transactions to the blockchain. Okay, so what is a miner? A miner is essentially a computer. Okay, and what that computer is trying to do is solve a cryptographic problem. Okay, and he's competing, or it is competing with a number of other mining machines to solve this problem. Okay, the first miner to solve the problem gets the right to write that group of transactions to the blockchain, essentially adding the next block to the blockchain. Okay, as a reward, if you recall from the second episode, that miner will receive 6.25 Bitcoin. On top of that, he will also receive fees. Okay, each transaction costs a small fee. So in the example again, where Alice sends 0.01 Bitcoin to Bob, Bob actually won't receive 0.01 Bitcoin. A small percentage of that goes to the network as fees. And that then is also what the miner receives. So the aggregate amount of fees in that block, he will also receive. So it will be 6.25 plus his fees. Okay, and then once the network confirms that the miner did indeed solve the problem, his block then gets written to the blockchain, and Bob gets his 0.01 Bitcoin less any fees that Alice had to pay. Okay, so that's a very simplistic overview on how mining works, but I wanted to illustrate it because I wanted to show you how Bitcoin gets mined and what miners earn. that's important for understanding the next indicator, which is the thermocap ratio. Okay, so what is the thermocap? The thermocap is effectively the aggregate amount of coins, that is reward and fees, that are paid to miners at any one point in time. Okay, so another way to think of it is it's the value at any one point in time that the network has been used to ensure its security. Now, why do we say that, right? Because miners writing transactions competing with each other, if many of them are doing it, it means that the network is effectively operating in a very secure fashion, right? It can't be hacked. I mean, I'm not going to go into too much detail about this. It is very technical, and I would say if you've got more time, it's probably worth spending a little bit more time than what I'm giving you. But just know that there's an incredible amount of computational power that goes into making sure the Bitcoin network works, right? And that's governed by miners and it's governed by nodes. Okay, so there's an underlying assumption here. Okay, we can calculate since inception the amount of thermocap, if you will, that's been earned, right? It's aggregated, right? So it's a running balance, if you will, over time. Now, what we know about the mining industry is that mining tends to run at tight margins. So effectively, the amount that the miners earn is equivalent or very close to the cost of mining. Okay, so the thermocap serves as a measure of the true capital flow into the network, right? That's really the underlying assumption. So if we take the market capitalization of Bitcoin and divide it by the thermocap, that then gives us this graph over here. Okay, and when the market cap and the thermocap are quite close together, the ratio is effectively close to zero. Okay, but what happens when the price of Bitcoin increases? Okay, the market capitalization starts to run away from the thermocap. Okay, and that would then be an indicator that Bitcoin miners who have now been gathering their rewards will now be prepared to start to take profit. Okay, and by taking profit, they're releasing new coins into the market, and that then creates downward pressure on price. Okay, what it'll also indicate possibly is that now miners with their profits are possibly willing to spend more on infrastructure so that they can stay ahead of the game, give their operations more computational power. So the cost of securing the network then increases, and that could also get reflected in the Bitcoin price premium. So in other words, what you would pay in fees, and that therefore then could also continue to create downward pressure on price. Okay, and again, looking at the graph, you can see that as the thermocap ratio spikes, they tend to coincide with market tops. Okay, shown by the little circles in the graph. Okay, so it's a little bit uncanny that it happens that way, but again, a good indicator that we are reaching market top. Okay, so that covers the thermocap ratio. We will now talk about the other two indicators that I use, and they're probably a little bit secondary to the first two, but they are worth tracking nonetheless. Okay, and that is the stock to flow and lengthening cycles, diminishing returns progression. Okay, so what is that? If you recall from the last episode, we said that lengthening cycles, diminishing returns, and stock to flow could give us indications of predicted market top over the next market cycle, right? Which is between the halving in May 2020 and the next halving sometime in 2024. Okay, and I'll focus on the stock to flow first. The stock to flow cross asset model predicts that we should expect an average Bitcoin price of around $288,000 per coin. So what we can do is we can track the current price relative to what the stock to flow model predicts. Okay, and as long as we continue to track the stock to flow model, there's reasonable confidence that we are likely to then achieve that average Bitcoin price. Okay, so although I'm primarily watching the NUPL indicator and the thermocap, as we saw in those examples, that you could get a false signal. So a secondary one that I would be looking at would also be how we are doing relative to the stock to flow model. Okay, and if we're quite far away from that 288,000, but the NUPL indicator suggests that we've reached the market top, it is possible, therefore, that it could be a local top and not a market cycle top. Okay. Similarly, if I switch to the lengthening cycles and diminishing returns graph, you can see I've got the red line, or the red band, I should say, which is the market top predictor for lengthening cycles and diminishing returns. And again, if the price sort of makes its way into the red band, that's an indicator that we are reaching the market top. Now, the one thing I like about lengthening cycles diminishing return chart that the stock to flow chart doesn't really show as clearly is the lengthening cycles diminishing return chart also gives us a nice indication of fair market value. Okay, and that's represented by the green band. So when the price settles down into the green band, you know, assuming of course that lengthening cycles and diminishing returns is what's dominating the price profile, we get a reasonable sense of fair market value. Okay, so you can use the LCDR chart for determining market bottoms as well. Now, if you recall again, the back end of the last episode, we asked the question, you know, which one is right, okay, or which model is right. And again, obviously, all models are wrong, so there is no right model. But which one is giving us the better information? Okay, so what I'm doing at the moment, although I'm confident that I'm more confident in stock to flow at this point in time than lengthening cycles, diminishing returns, I am watching the chart that we looked at in the last video, our last episode, that's tracking the return on investment for this market cycle relative to the first two market cycles. Okay, as long as that red line tracks in between the first market cycle and the second market cycle, I'm leaning more towards stock to flow. But if that line starts to dip below the blue line you see there, that could be an indicator that lengthening cycles and diminishing returns is taking over, okay, or is becoming more dominant. So I would therefore then look for a market cycle top as depicted in the lengthening cycles diminishing returns chart, that red band that we were looking at early on, rather than the stock to flow model. Okay, so that really brings to a close this episode. I think if you're only investing in Bitcoin, this should be useful information to you. We are going to change gears in the next episode, and we are going to look at the altcoin market and what I'm going to be doing there. But right now, the main focus for me is looking at and understanding what Bitcoin is doing. Okay, so once I start to hit all these indicators for Bitcoin, I then start to pay attention to what the altcoin market is telling me. Okay, remember the premise: where Bitcoin goes, altcoins will follow. So we'll dive into what I'm doing for alts in the next episode. I hope you've enjoyed this one. Hope you found it interesting. And again, thank you for participating and giving me your attention. And hopefully we will see you in the next episode.